Hello and welcome to the CNBC TV 18 News Center. I'm Sumaira Abdi and you're watching MF Corner. On the show today, Hemant Rustagi of Wiseinvest joins in to talk about the impact of the rising bond yields on debt fund investors. And also a little later on the show, we'll connect with Vishal Dhawan of Plan Ahead Wealth Advisors, who's going to tell us what to do since the status quo on international funds continues as of now. So first up, let me invite Hemant Rustagi of Wiseinvest to talk about, what debt fund investors should be doing. Hi, Hemant. Good to see you. So, we've seen bond yields on the benchmark bond, that's a 10-year bond, now touched 3-year highs. They're at almost 7.2%. So what does this impact of the rising yields mean for debt fund investors?
Well, Samara, before I talk about, how the rising yields are going to impact the debt fund investor, let me just explain why these bond yields are rising. These are rising basically in line with the global rise in bond yields, as well as the expectation of rate hike by the RBI. Although RBI hasn't yet, increased the interest rate, but I think there are clear indications that this is going to happen soon. In this month's credit policy review, RBI projected the inflation to be at 5.7% for 22-23, as against 4.5% in its February 10 policy review, which is significantly higher. So clearly there are indications that the rate hike will happen. And the second important thing is that so far RBI has been focusing on economic growth, of course, by also keeping an eye on inflation. But now the priority has changed. The top priority now is to contain inflation and then economic growth. So as I mentioned, I think there are clear indications that the rate hike is going to happen. Now let's come to the impact of rising bond yields on the bond fund investor. First, I think it's important to understand that there is an inverse relationship between the bond yields and the bond price. So whenever the bond yields go up, the bond prices come down. And since in the mutual fund, the NAV is calculated, especially the open-ended funds, on a daily basis, and there is a mark-to-market, it brings the NAV down, and which obviously impacts the return negatively. So whenever the bond yields will rise, you will see that the bond price is going down, and that will bring the NAV down. So that's the first impact. Second, I think it's important for every debt fund investor to understand that the longer the average duration of the portfolio of a mutual fund, the higher is the impact of interest rate changes. So, for example, there are certain categories like medium to long or longer duration or yield funds where the average maturity is longer. The impact is much more there as compared to other categories like overnight fund or a liquid fund or an ultra short-term fund or a short-term fund. So it's very important for every debt fund investor to understand that while there will be some impact on the portfolio whenever the bond yields rise, they need to closely look at their portfolio and see the kind of fund they have to understand what kind of impact will be there on their portfolio.
Okay. Fair enough. But, debt funds have been out of favor for some time, right? Because returns have been muted. But in March, we've seen that every single category of debt has seen outflows. Does that tell you that there is some sort of preference which is shifting now to either equity or hybrid funds?
Well, Sumara, you're absolutely right. I think barring a few category of funds like overnight fund or a liquid fund, most other categories of debt funds have witnessed heavy outflows, which obviously there are two reasons for that. One is that there is this impending interest rate hike by the RBI, and of course the lower return that have come for the debt fund investor. A lot of that money has moved out from the debt funds, as some part of it has gone into the fund which are ideal for parking, like overnight fund and the liquid fund, where maybe investors are waiting for the opportune time again to reinvest or relook at the portfolio. A part of that has also gone into hybrid funds, and of course some money has also moved into equity fund. Especially in the cases where investors thought that they can wait out for a longer period. But I think especially I would mention here hybrid funds are definitely back in favor, especially those investors who do not want to invest or have a lot of exposure to equity. They have preferred hybrid fund. But I think I just want to add here something for the debt fund investor, that it's not that everyone has to be in panic and need to react to this hike in the bond yield. Like I mentioned earlier, if you are in a shorter duration fund, let's say where the maturity is 6 months, 3 months, or maybe 1 year, well, what happens is that significant part of the return comes from accrual. So these funds will be able to reinvest at a higher yield. So you will benefit from that. So do not react haphazardly, do not react abruptly or make wholesale changes in the portfolio. But you're right, absolutely, that that people are moving this money to equity and hybrid funds.
Okay. So, Hemant, if, let's say hybrid, for example, if this is an alternative, especially for the debt plus investors, and, within this, the most popular category has been the balanced advantage fund, which has seen the maximum inflows from any category in the last year, right? But now we are seeing that, flows have been tapering and, very minimal flows in March. So what explains that? And, even a relatively safe category like, say, arbitrage funds, they have seen massive outflows. So, I mean, if money should be coming in, why isn't it reflecting?
Well, I think we need to look at it differently. Let's talk about, as you mentioned, a balanced advantage fund. I think that's one of the popular categories where a lot of money has flown in. And another category, which is equity saving. Now, the good thing about this balanced advantage, this is also called the dynamically managed asset allocation funds. Equity exposure depends on where the fund managers see the market. If they see overvaluation in the market, they bring the equity portion down, and wherever there's undervaluation, they bring the equity exposure up. The rest of it is invested in arbitrage and debt. You are right that maybe there is some kind of tapering down we're seeing in terms of the money that is coming in, but I feel strongly that this is a category that will remain popular. You will see inflows in this fund happening even going forward. And the reason being that for many common investors, it becomes very difficult to decide how much money should go into debt and how much should go into equity. Here, because the fund manager reallocates money to different assets, I think it becomes much easier to handle. Now, let me come to arbitrage fund. Arbitrage fund, again, is a great option, especially for those investors who are in the higher tax bracket. Of course, in the last, I would say, year or so, the returns have gone down for two reasons. One, I think the equity market was doing very well. The market was going in one direction. And arbitrage fund is a fund that actually benefit from the arbitrage opportunities that exist between the cash market and the future market. And since those opportunities were not there, it impacted the return, and that's why you saw that outflow happening from there. But if you look at the current scenario, there is a volatility in the market, and the volatility is likely to continue going forward. So I see that there will be maybe better opportunities for the fund managers to, invest money effectively in the arbitrage funds and maybe offer better return. And these funds are also popular because of tax efficiency of return, because the taxation is of equity. So I feel that maybe they'll find some favor back going forward. But you're right, yes, they have disappointed in terms of return, and that's why we saw the money flowing out of these arbitrage funds.
Okay, so this is one option, but clearly these bank FDs and all have been ruled out, for investors. So, in this situation, how would tax-free bonds be as an alternative for debt fund investors?
Well, so as far as the tax-free bonds are concerned, they are obviously considered to be a safer option, and the best thing about them is that the returns are tax-free. It works very well for investors, especially in the higher tax bracket. But there are a couple of important things that investors need to keep in mind if they're looking at, investing in these bonds. One, there is no fresh issue of tax-free bonds happening. So if anyone who were to invest in these bonds, you have to buy it through the secondary market. One issue which is always there with these bonds is that there is a lack of liquidity. One. Second, anyone who wants to look at this as an option has to be very sure about the holding period. Look, if you want to hold it till maturity, let's say if the maturity is 6 or 8 years away, then it's fine. If not, if you're going to exit again from this later on, you will have an issue again because you will have to face the impact of interest rate movement there. So I think that's something that investors need to keep in mind. I believe that currently, even though the YTM has risen a bit, still not very attractive, especially for those investors who have a time horizon of 6, 8, 10 years. I personally feel that hybrid funds can be a better option here than investing in these tax-free bonds because one, there is a lot more flexibility. Second, because the asset allocation is managed dynamically, I think these funds have better prospect of offering returns as compared to the tax-free bonds.
Understood. Hemant, thanks very much for your recommendation, and thanks for explaining this as well. So with that, we're going to take a very quick break. Up next, another interesting topic, what to do if you have funds which have overseas exposure because the limit has not yet been hiked. Vishal Dhawan of Plan Ahead Wealth Advisors will join in to talk about the options for investors. Stay tuned.